For what feels like forever, the global financial system has just been swimming in the sea of easy money. But something's changing, quietly, but for sure. All over the world, these little stress signals are starting to pop up in the money markets. It's like the tide of cash is finally starting to recede. So let's figure out what these signals are really telling us. So here's the big question, right? Where is all that easy money actually going? It feels like the financial plumbing of the world is starting to groan a little. It's under pressure, and we're going to follow the clues to figure out exactly why that is. All right, first things first, let's get on the same page. What even is liquidity? Well, it's pretty simple, really. It's just the amount of cash or stuff that can be turned into cash fast, sloshing around in the financial system. The easiest way to think about it is like a giant faucet of money. And for the last decade or so, central banks had that faucet cranked all the way up. Now? Well, now they're starting to turn it off. And right there, that's the real crux of the issue. You've got central banks pulling cash out of the system, while at the exact same time, governments need to borrow more money than ever. These two forces are just colliding head on. It's creating this massive competition for a shrinking pool of cash. It is, the definition of a classic squeeze. Okay, clue number one, we're starting our investigation in the US. Why? Because that's where the signals of this cash crunch are, well, the loudest and the clearest. You could say it's ground zero for this whole thing. So, our first piece of hard evidence, it comes from something that sounds a bit technical, but it's super important. The rates banks charge each other for overnight loans. This is like the absolute bedrock of the financial system, the nuts and bolts. And these rates, they're supposed to stay inside a very specific target range set by the Federal Reserve. But guess what? Lately, they've started to creep right past those limits. And here's a perfect example. Look at this SOFR rate. That's the Secured Overnight Financing Rate. It's a really key benchmark. Now, the Fed wants it to be between 3.75 and 4%. But look where it is, 4.32%. It has literally jumped clear of the Fed's target. And what that tells us, plain and simple, is that the system is so starved for dollars that the real cost of borrowing is now higher than what the central bank even wants it to be. And if you're wondering why this is happening, just look at this number, $2.2 trillion. That is how much the Fed has shrunk its balance sheet by in just 3 years. That is just a mind-boggling amount of liquidity that's been systematically sucked right out of the financial world. And here's the kicker. We are already seeing the fallout from this. Banks are now regularly having to go to the Fed's emergency cash window, the very same facility that was set up as a last resort after the last liquidity crisis back in 2019. I mean, if that's not a clear sign the system is feeling the strain, I don't know what is. All right, let's jump across the Atlantic. Clue number 2 takes us to Europe. Now, the story here is a little different, but you're going to see that the underlying theme, this tightening of cash, is exactly the same. So, check this out. In the UK, things are pretty volatile. You're seeing these sharp spikes in what are called repo rates, that's just short-term borrowing, because banks are having to repay these huge, cheap loans they got during the pandemic. Now, over in the Eurozone, things look a bit calmer on the surface, but the tightening is definitely there. It's more subtle. All that excess cash is just quietly draining away. Okay, now for clue number 3. And this is where our investigation takes a really fascinating turn. Because while the entire Western world is tightening its belt, China is doing the exact opposite. We're talking about a major, major split in the global story. Think about it like this. The Fed and other central banks in the West are selling off their bonds to pull cash out of the system, right? China's central bank is getting ready to buy government bonds to pump more cash in. It's like the West is slamming on the brakes while China's hitting the accelerator. You couldn't get a more different approach. Okay, so we've got our clues. We've looked at the US, Europe, and China. So what does it all mean when you put the pieces of the puzzle together? Let's solve this thing and figure out what this new reality looks like. So let's just recap the big picture. You've got the US, where short-term rates are spiking under pressure. You've got the UK, where things are getting volatile as that pandemic support ends. Then there's the Eurozone, where all the extra cash is just quietly disappearing. And then, completely bucking the trend, you have China, which is actively trying to add more cash. The world's biggest economies are literally pulling in opposite directions. And this quote here, it just nails it. World money markets must now find their place in a world without excess reserves. For over a decade, the whole system had this huge safety net of extra cash, right? It was always there, courtesy of the central banks. Well, that safety net is gone.
And now, the markets have to figure out how to stand on their own 2 feet again.
Which, of course, leaves us with one final pretty big question. The era of easy money is clearly over. We know that. But is the financial system, is it really ready for what comes next? Because the signals we're seeing, well, they suggest this transition might be a little bumpier than anyone was hoping for. Now, if you want to follow this story as it develops, check out our Telegram channel. The link is right there in the first comment. That's your Daily Edge. See you next time.